There has been a bit of dry powder, and you know that the number of investments that have been occurring has been lower, and you know level of due diligence has been higher, and investors have been more careful in selecting what they go into.
Liquidity is very topical now. Like, you know, every room you walk into, someone's talking about liquidity. People go, "Hang on, I signed up for a 10-year fund cycle, and you know, I'm 13, 14 years in. Where's my money?" Yeah, there's not a whole lot of banks lending for home loans against ESOP.
But the other thing is that the appetite for generic funds has been lower from LPs. They've been looking for themes. You know, they've been looking at climate tech, med tech, biotech, even a move back to some hardware type IoT.
Hey, welcome to the third episode of the Accidental VC. I'm Milan Reinartz, founder and CEO of Non-Public. On this podcast, we talk about different issues, challenges, opportunities that we see in venture capital across Southeast Asia, Australia, and the US. Today, we're here in Sydney at the Sydney Startup Hub, and we'll probably be focusing a little bit more on Australia. But let's see where we go. I'm joined here by Hugh and Jack. Please introduce yourselves as well, gentlemen.
Go for it, mate.
Hi, I'm Hugh. I've sort of been a long time player in the tech industry in Australia and moved into VC quite a few years ago, and have been working with a number of funds and currently a director of Non-Public here in Australia.
Cool. My name's Jack Richardson. I'm the founder and managing director of Hamia Group, which does pre-IPO brokerage primarily out of Silicon Valley, but a few other markets globally. And yeah, excited to be part of the conversation.
Thank you for joining.
Cool.
I think there's a good mix because we have a good mix of sort of exposure to early stage investing and later stage investing and brokerage. Maybe we can start there. What have you sort of seen over the last couple of years? How the VC industry here in Australia has been developing?
Yeah, I think it's been a difficult few years. I think post COVID, while the market adjusted to a post COVID world in terms of venture capital, and I think a number of the offerings and the way people are investing have changed over the last couple of years. We've seen growth in secondaries. We've seen, less IPO and M&A activity, which has created a kind of bit of a liquidity issue, which has driven that growth in secondaries and so on. So, yeah, there's been quite a bit of change. I think the confidence is returning to the market now, but it is still very measured. There's a lot of macroeconomic confusion going on in the world and I guess uncertainty in the world at the moment. And I think once that starts to show positive signs, I think investors are there ready to move.
And do you see changes in the sort of deployment velocity and volume in early stage startups or early to growth stage startups in Australia specifically, since there's actually quite a few big funds. I've just been learning more about the AUM sort of under the belt of some of the bigger funds here.
Yeah.
I guess there's a need to deploy. So do you see that deployment slowing down or
there has been a bit of dry powder and that's been the number of investments that have been occurring has been lower and the level of due diligence has been higher and investors have been more careful in selecting what they go into, I think. So, that has done it. There was 414 VC deals registered last year at about $4 billion, which was up 11% on 2023. The first quarter of 2025 has been pretty positive. It's about 800 million in the first quarter. That doesn't count secondaries, that number, and it doesn't count some of the other venture debt type growth that's been occurring. So a lot of founders have been looking towards the venture debt as a non-dilutionary form of capital, also driven, I guess, by the move from growth to profit. and a focus on breaking even. So a lot of recurring revenue streams have been attractive to venture debt providers. So that's kind of been growing as well.
Yeah. I was going to say, I think founders also drove part of that change, right? They started thinking about what fuels a better exit outcome for them a little bit, and that started to feed into venture debt and different sort of strategies around how they grew their business. But I was going to say, on the pace of deployment, I think at the top end and the big funds, I feel like, yes, they were much more careful, potentially 2022, 2023, but I think their pace of deployment has been somewhat steady, and whether that's a result of having dry powder that they had to deploy to stay on schedule with their raises and their fundraising schedule and things like that, I don't know. Or maybe just the AI boom gave them enough sort of companies that they could back. But I do think it's been somewhat consistent, although there was a trough, but to your point, picking back up, which kind of smooths things out overall.
I think there was an interesting figure I saw through the Cut Through Ventures report that said 23% of VCs raised funds last year, which is not a huge
percentage.
Yeah, so a lot of them had capital already, right, from previous periods, obviously, but only 23% of them raised last year, and I think the VC market has had difficulty raising for new funds, particularly if they don't have prior funds, if they're relatively new and they don't have a history. But the other thing is that the appetite for generic funds has been lower from LPs.
Family offices.
They've been looking for themes. They've been looking at climate tech, med tech, biotech, even a move back to some hardware type IoT options, AI, and so on. So they've been looking more for thematics-led funds rather than just the generic seed fund.
Interesting. Yeah, I was just at a Gendel family office event on Monday, and they were also saying they're mostly focused on direct deals, and interestingly, which we see that theme in Southeast Asia as well. That more and more family offices are actively investing in individual opportunities directly, and essentially are building their own teams of analysts and so forth, which is interesting.
I think lots of things happen in the US and then they trickle down eventually, right? And that's no hot take. But I think that's something I really noticed 21, 22, this growth stage trade, which is sort of more my focus versus the early stage, became probably the hottest trade in financial markets at the time. And these family offices probably weren't ready for it, and they weren't as sophisticated, and as a result they had to rely on brokers and they had to pay brokerage fees and all of these sorts of things. And I think once the lull period hit, to your point, a lot of them reorganized and reshuffled the decks and brought people in on a full-time basis to adjust their strategy. And I think they kind of looked at it whereby they could, if not index parts of the market by participating in funds, they could sort of get a degree of broad spectrum access and then potentially leverage their relationships with those funds to then go direct at the best performing companies. And then that was in addition to their in-house sort of analysts and teams. So if they say they had a 20% exposure to venture into private markets, that maybe was scaled back to 12 to 14% in funds, and then there was this allocation that they had where they began to go direct themselves. And to your point, I think that's starting to happen in Australia, where the big family offices are starting to work together on this concept of direct secondary
and build a capability.
Yeah, plus I think like they want to get an immediate impact from a transaction as well. Like if you're in a fund and there's a transaction, it's not necessarily going to come back to the LPs until the fund's reached a certain stage, right? So
and you're also watching from the sidelines rather than sort of having a seat at the table, right? Or
that's right. Yeah, you can have more involvement with the founders or with the business and so on if you're directly engaged. But also, if there is a transaction,
you get the money.
You get the money. Better liquidity.
You have to wait until the whole principle is covered and so forth. Interesting. I mean, maybe double clicking a little bit on the US secondaries versus the secondaries market here, and I guess there's a lot of considerations around DPI and so forth, but maybe firstly just from an sort of LP and also retail wholesale mass affluence investor point of view. What do we see here as sort of market trends, or how that's shifting, changing? What do you think should happen more? What should people pay attention to as a private markets investor?
In the growth stage specifically?
Maybe across stage, but from your point of view, I guess more on the growth stage side, exactly.
Yeah.
Because there are some big companies here, like Canva.
Absolutely. I guess to take a step back, it's been an interesting journey for me since sort of coming back to Sydney and coming to Australia, because having spent, 3-4 years with my head down in Silicon Valley, and then coming back to Australia, what was so normal there, I expected it to be part of the conversation and very well known here. And liquidity is very topical now. Like, every room you walk into, someone's talking about liquidity. But go back 2.5-3 years ago, and I was barking about liquidity, and people sort of looking at me like, "What is that? What are you talking about?" And you laugh, because it really was like that.
It's like they'll IPO eventually, sort of.
Or just like, why? Why are you talking about that? What we're doing works. Why do something different?
Our valuations are going up on paper.
Canva just raised at $40 billion val. Why would I do anything else? And then, you get the downturn, and people want cash. They want to capitalize, and they want to buy different assets, and real estate in Australia is very expensive, and there's all these sorts of things. And all of a sudden people go, hang on, I signed up for a 10-year fund cycle, and I'm 13-14 years in. Where's my money? And I think there's a lot of people that would like the Canva proceeds. And I think to the point about, some of these funds that are struggling to raise a second fund and all those sorts of things, there's a hell of a lot of capital tied up in Canva that yes, it will fuel the next stage of the industry in this space, but it's not quite there yet. And I guess to take a step back around liquidity and what are the conversations, there's lots of people asking for it, but people wanting it and there actually being a solution that works are two very different things. And I think, the rubber hasn't hit the road beyond sort of some of the big funds returning some capital to LPs via the secondary sale in Canva last year. And I mean, I can understand their approach, because you look at the growth rate on that revenue base of Canva, you could say that they would not be, upholding their fiduciary duty if they did sell everything, Right. You can very, very much understand why they're holding for the most part. So I can understand the strategy, but the reality is it's a problem. And I guess, to speak from my experience, the ways people have tried to solve that, to take a step back, the biggest problem is probably that there's restriction on transfer on the vast majority of shares. Yes, of shares in private companies that goes beyond ROFA.
Just general restrictions.
Like board approval is required to transfer equity, particularly at the common stock level, which is what employees hold. And as a result of that, we really don't have too much price discovery. We really don't have a liquid secondary market.
As opposed to what you see in the US, essentially.
Exactly right.
Forge your equities and these kind of...
Yeah, I mean, I can explain that a bit further if
sure,
you want.
Sure, it's interesting for people if it's something that's not so active yet here. So.
So, I think in a lot of ways, we trail the US, and that was sort of this consensus that, we'll just do what the US does around liquidity. But I think what people don't realize is the US is actually learning from Australia and Canva in a way and sort of mimicking that. And what I mean by that is a lot of these American companies had very liquid markets that founders got frustrated about, because Common was trading at 150% of the last price round, which then makes it difficult to fundraise and all these sorts of things. So the founder wanted control of the cap table again. And what they did was they ran these tender processes, or they created bylaws that if you participated in a tender or if you sold some equity, you were then subject to new bylaws that basically created the same rules that Canva has, which is all transfers are restricted without board approval. And so stock gets locked up and there is no liquid market. So Australia, the US has kind of learned from that. And so I think we're actually going to go into an environment where there's less and less liquidity for individual names, and the key becomes access, which we've discussed. But what sort of came to Australia with Canva were things called forward contracts, which we don't really discuss here, but they're a derivative contract whereby the buyer and seller do a they that should normally involve the company, but they remove the company as the third party because they know that it's required, and lots and lots of money was pouring in offshore for Canva for that, and it sort of went.
But also a bit risky from the buyer side.
Oh, incredibly risky.
Sophisticated buyers don't like forwards.
No, not at all. It's essentially the seller still has the shares and the money, and it's just a hope that they deliver the shares after the IPO. It's very risky on the buy side, and it's not good business practice.
So can you spot me for my shares?
Yeah, it's madness. But this is what was coming, and this is what happened, and it will probably continue to happen if we don't find a solution. What that is, I don't know. I've got a whole lot of ideas, and we could talk about that forever. But yeah, as of right now, that's a massive challenge in the Australian market.
Interesting. Do you see much secondary transactions in your time at Investible? Do you see much secondary transactions in sort of maybe not the Canva safety culture or Atlassian type pre-IPO companies, but rather the growth stage, maybe when companies are 50, 100 million, few hundred million valuation? How does that look in Australia?
Yeah,
perhaps compared to other places from what you've seen.
I mean, the appetite for the secondary sale is there from early investors, right? There's a bunch of early investors who are saying, look, it's gone 5x or 10x, or I'm happy with that. I want to, at least sell down partially or the lot. So the appetite's there. It's starting to happen more. A lot of the funds, the VC funds who have reached maturity, are now, saying we need to start feeding capital back to LPs. We want them to invest it in our next fund.
Yes.
And we want to show performance, right? So the appetite's there, and it's increasingly happening, but it's still limited.
Yeah, I think I was going to say part of the challenge is the buyer pool too, right? Because it's all well and good to say I want liquidity, but who buys it? I mean, we've got second quarter, but what was the size of their fund? It's 100, 150 or something. Yeah, it's not even close to being able to handle what's there, and then beyond that, there's tons of secondary funds in the US and all those sorts of things. But I can tell you from people I've worked with, there was only one name they were chasing, and that was Canva. And beyond that, like I mean, I'd pitch safety culture, I'd pitch culture amp, I'd pitch just no
Doesn't
interest.
Get a demand.
No, because you got to think about
there's no market education about it, so the kind of mass affluence doesn't really consider it.
No.
At this point, or
well, I just think when you buy a secondary, you're buying it as an IRR trade to an exit, and if an exit's a $10 billion valuation on the Nasdaq,
it could take a minute.
Yeah, we don't. What guarantee is there that these businesses get there? And then when you start to talk about smaller businesses with some of these other funds that aren't probably the big three at a $200 to $800 million val, where does that go? Is it a private equity buyer? I don't know.
Yeah. I mean, the ones I've seen have been basically an investor coming in and soaking up some of the early investors by wanting to, make an offer to take new stock and some secondaries from early investors.
Makes sense. And also there's a primary funds buying off other primary funds, right? So to increase their holdings or... I mean, PE is starting to get more interested in the later stage businesses in Australia, but and I think that's certainly growing, but it's still, it's not massive.
Yeah.
I mean, there might also be. I mean, in the US, in the US, I see that there are certain names have a lot of liquidity, so like SpaceX or OpenAI and so forth. So even if you especially if you have size, if you're an institutional player or sort of family office player, and you're buying, a few millions of any such, the big name sort of thing. It's if your structure is clean and your expectations are reasonable, it's almost immediate liquid. I mean, it might take a couple of months to process, but there's almost immediate liquidity, right? So on the other hand, maybe like going one step further, once you buy into, as you said, to then have to wait until IPO. The ideal scenario is that you can come in, but you can also go back out, so that there's overall sort of longer term liquidity, and then there's the rougher or general transfer restrictions piece, as you mentioned, which the companies don't necessarily want this to happen, right? The founders of the companies don't necessarily want this to happen. They don't want the market making, the kind of price discovery to happen. They don't want to see a sort of they don't want to see it as a signal of people are selling off. I'm a sell, rather 100%. Than so. There's all these factors, but I'm seeing this a little bit in Southeast Asia in the early stage space, that there is some education and I guess conversations going on around. There's nothing wrong. It's not a sell signal if an investor who's realized 5x, 10x sells. It's just part of the game, and I think founders are starting to sort of be more comfortable with that, right? And it goes both ways, right? So we run an angel club in Singapore, and so we have seen folks approach us to say, hey, can we buy your shares in this round? And then we offer it. They offer it to the angels, and then the angels can decide to sell, or vice versa. That somebody says, "Hey, there's only a small allocation, but we would like more." So you can talk to the founder and say, "Hey, if anybody's willing to sell, we'd be happy to buy more." And we see some support for this sentiment now in the Singapore market or Southeast Asian market. Is that sort of what you're getting at? What you think isn't quite happening here, and that should be happening?
Yeah, no, for sure. Yeah, I'd love to see that happening, right? Like. I agree with your point. It's almost like there's like three markets, right? There used to be the public markets and the private markets, and now there's public, private, and there's sort of this group in between of like maybe 20 companies that
private liquid.
Yeah, exactly, right. And there's been a lot written about it, so that's not a hot take either. But there's probably these 20 names, of which Canva would be one globally, that. There's a very clear path to them going public. The performance in the public markets is expected to be strong, and within those, there's a lot of transacting within SPVs and things like that. So yeah, I agree. I agree completely with that point. Apologize, I've forgotten the other part of what you're saying. I forgot.
More the founders being embracing. The transfer restrictions. I think there's a good reason for transfer restrictions. Generally speaking, there are many good reasons for them, but that's not to say that there aren't also good reasons for liquidity between investors, and that the market sort of, I think, ideally, in my view, in startup investing, I'm talking sort of from the early to growth to late and pre-IPO stage. Ideally, there's a sort of more knowledge around this and more conversations I had about it, that folks sort of embrace that, hey, that's part of the game. And if some of my investors are selling shares to each other, that's not I don't have to hide that. That's not a bad thing, To not sort of categorize that it's not bad or good, it's just part of the market kind of thing.
Yeah, and I think once like you actually explain the trade to people, we chatted about this offline, but it's like once you say to people that Amazon and Google, Microsoft, they'd go public after 6-7 years or whatever it may be at a market cap of, I don't know, $1 billion, $2 billion, and now things on average go public after 11, 12, 13 years at gigantic market caps. It doesn't take a rocket scientist to work out that there's this 6-year window now of gigantic value capture, that people that were once public market buyers want to come early, and people that were once holders until an IPO after 6 years will become sellers after 9, 10. So there is this new period of time that once people understand the trade, the opportunity, and just how market dynamics have changed, they very clearly understand. But to your point, that's education, and unfortunately, that's very much missing in Australia.
That's very interesting.
Yeah.
Okay.
Yeah, I kind of feel like there's a bit of an information gap as well. If it's Canva, everyone knows it's what's going on in terms of its growth and its product releases and a whole bunch of stuff. But if you go down a few levels to the smaller scale up who are trying to do secondaries, it's a lot of effort for the founders they don't actually get any benefit out of the secondary sale necessarily. And so why would they provide information to inform investors in a secondary transaction around how they're performing and what's going on and what their plans are and so on. So you've kind of got to have a leap of faith if you're buying into without a company without that information.
It's tough because it's the same buyer pool for, pretty much same buyer pool for secondaries and their next price round, right?
Exactly, and they don't want they don't want to do a 20% discount to a round they're about to do, right?
Yeah, exactly. It's tough, and I think it's tough at different levels because there's different scale. But I've seen in the US and no doubt probably some of the bigger funds here do it as well. There is liquidity and there are secondaries, but they don't necessarily hit the open market, right?
Hush.
Well, yeah,
closed door deals kind of.
And you blend your costs down.
Yeah.
If you buy, $100 million of secondary at $1 billion val, and then you put another $100 million in from your fund at, 1.2, your blended's 1.1, and you do that across 5-10 portfolio names. What's that worth? What's that worth in IRR?
Yep.
And that's a question
2 points, 3 points. I don't know.
Yeah, and that's a question they're asking a lot now. It's like they're coming into a new transaction, a new raise, and saying, is there any, can I pick
up? Any willing sellers?
Yeah. Is there any willing sellers? Can I pick up some secondaries at a discount?
But that's a US model.
That's also a good thing, right? That's a good thing for early investors.
Yeah.
It's as I say, that is the US model in the boom times, right? Too. I think people don't realize that. They talk a lot about how underwater some of these funds are from 3-4 years ago. True, it's not ideal, but also there was a strategy there whereby they were buying a huge amount of secondary and then almost 6 months later leading around, and people were saying, so that's crazy, but they're kind of marking their own book up in a way, and their blended cost is not that high. And look, it's not perfect, but it was a strategy that had some success for a while there in the US. There's merit to it, but who is it the best outcome for? I guess that's where debate comes in.
Yeah, a lot of high net worths that got interested in early stage investing and started, buying in to early stage companies and funds and so on. They've got a limited capital pool, and they've been doing it for 5-6 years. Yeah, that they have no capital. There's no more capital to put in unless they start to recycle some out, right?
And it's not recycling.
Yeah, exactly. So
it's close, but not there yet.
Yeah, it's important to get that recycling happening, because those people are going to lose interest if they're just putting money in and never getting any out. And it's the same with employees on ESOP as well, I guess. Yeah. If they're holding stock for years and years and years and not getting any liquidity, they start to lose interest in.
Yeah, there's not a whole lot of banks lending for home loans against ESOP.
No. But it would Silicon Valley Bank kind of
paying school fees. Yeah.
Maybe that's a good segue to another topic we want to cover here around regulatory and tax under the Australian regime. I saw Labor had released a proposal for new taxation of unrealized gains. And there's obviously a ton of implications here for private market or illiquid market investments. I'd love to hear you guys' thoughts. You've both been active in the markets across different stages. I'm guessing it's not something we're excited about here.
No, not at all. But I just don't think that the implications of that policy have been thought through. While it will provide some income in the short term to the government to fund short-term election promises that they've made, it will have a devastating effect on long-term venture capital.
Investing.
Investing and so on. So I think it's on superannuation. Right, so I guess that's an important clarification here, is that it's on unrealised gains within superannuation portfolios and currently proposed at amounts above $3 million. But that's if you've got $3 million of assets on the book.
In total?
Yeah, in total.
Okay.
So, where it really comes into play is if you've got equity in companies where the valuation's gone up considerably from where you invested, which is what we're all trying to achieve here, right? Yeah. We've had a lot of write-offs, okay, because this is a high-risk, segment. So,
and do they get deducted, the write-offs? Can they provide tax deductions, the write-offs of companies under this proposed regime? Do we know this?
Well, if the valuation goes down of an asset and you've paid tax on it at the higher amount, no, you don't get the tax back.
Okay.
So
it's on an annual basis essentially. Yeah.
That's right. It's assessed annually, and if the value of that stock's gone up in the 12 months, you will pay 30% tax on the increase that's occurred during that 12 months. If it goes down, no.
Okay.
Not counted. Doesn't give you a refund or even a write-off against another gain.
And so it's on a per asset basis as well, or so you losers don't protect your winners a little bit in the same year?
No.
That's quite crazy. What about the intention here? I suppose is the intention more sort of more property and that kind of thing, where it's I suppose somewhat more reasonable. From a policy point of view, and this has just maybe been sort of overlooked.
It's not just on
startups,
on equity or startups. Yeah. It's across a whole bunch of asset classes. But it's just the concept of paying tax on paper gains, right? Like you don't have the cash to pay the tax on that gain unless you can sell the asset. Now, obviously, property would be a lot more liquid than private market equity. Right?
You have to lend against it to pay your tax, kind of. It's a strange thing, yeah.
Yeah.
Yeah, but it's going to have a big effect on investors who have been investing through their self-managed super fund into venture capital, and that has been a really big source of capital for venture. It has been people looking at, because it's a longer term investment, and there's been a lot of confidence around and incentive to reduce your tax over a long period of time in your superannuation. It's going to affect that.
So it's really it kind of could stifle innovation in a way, and sort of the technology ecosystem which you really want to blossom for other parts of the economy, of the economic consideration.
In a vertical, we for the most part are crying out for government support to boost innovation and to drive dollars and support of new innovation. It's
to support jobs,
right?
and future, bigger business, right?
GDP growth it potentially doesn't make a whole lot of sense to bring in a policy that would prevent dollars flowing in that direction. And I think potentially the scariest part is that it's unindexed, and so what's may hit a certain percentage of people right now will become increasingly problematic and for a larger pool of people as time passes.
It's interesting. So this is something that we think the government ideally shouldn't do or shouldn't happen this way. Are there other things that we think would be helpful in terms of some of the issues we talked about before, but also generally for the technology ecosystem, for more liquidity, for tech employees, for entrepreneurs in a sort of healthy way? Are there other areas of consideration you think that the government here needs to consider as time goes on?
Yeah, but you mentioned, Jack, about the ESIC and
I'm very passionate about some of the ESIC laws, which for the most part I think are terrific.
And ESIC is, for clarity, is like ESOP.
Tax considerations to promote venture investing, essentially, and one in particular that sort of isn't focused on by a whole lot of people. But again, for me, in my journey of trying to understand secondaries in this market and trying to understand why we didn't have a liquid secondary market, why there was very little price discovery, I went down sort of the rabbit hole on the 2022 amendment to the ESIC sort of program. And one that I found very concerning and I would love to see changed it's twofold, right? Because I can really see the benefit of it, but it's very problematic for liquidity. So what the change was that employees are able to get long-term capital gains tax treatment if they were to exercise essentially the day before they sold, which in principle is an incredible idea. It's terrific, because the last thing you want is kind of what we're talking about with the self-managed super issue of an employee exercising, paying tax on that, and then those options being worthless, which is the same problem. So I think it's terrific innovation in that sense. But the only way you qualify to get that tax treatment is if there's, I can't remember the exact terminology, but it's essentially a genuine restriction on transfer, which the right of first refusal does not constitute. And as we know, the right of first refusal is very normal in the US. It allows the seller to go to a buyer, find their own price, go to the company. If the company wants to acquire those shares, or a board member or someone, then have at it. Whereas in Australia, the sellers, or certainly the employees, have no ability to do that, because the legal right, they need the board and the founder's approval to be able to progress that transaction. And so it's a bit like, it's a bit crude, but like it's a bit like selling a house if you're not allowed to advertise the house anywhere, and there's only allowed 3 people are allowed to buy it. Like, are you telling me you're going to get best execution? Yeah, enough said, in my opinion.
Interesting.
Yeah, but I think, the whole sort of issue of tax concessions around early stage investing to promote people to invest, lower capital gains tax and everything is a really great incentive for people to increase their returns in this asset class and therefore be more inclined to put money into it and therefore grow the sector. And this is really imperative to Australia's future and a lot of other countries' future. We've got, manufacturing's declined, obviously, and AI is going to revolutionise the workforce, and we need to, start to develop new areas of growth. And technology is one that we can be super competitive in. We've shown that with, companies like Canva and Safety Culture and Airwallex and a whole bunch of, so we, this is what we want our kids to be doing, right? You get sales people, finance people, coders, testers, creates a whole lot of great employment opportunities.
I was a bit negative then about that particular part of it, but I agree. Overall, it's brilliant because.
So, how can that be like I do understand the problem you're pointing out. So how can that be improved? Is it just sort of industry norms, or what conversations need to be had to kind of to improve that situation? Or what are the options also to I guess invest? What are the alternatives for investors?
Look, there's that change came on the back of a recommendation from a law firm that was sort of supported by a number of prominent people in the tech industry in Australia. So it sort of was designed by the tech industry for the tech industry in a way. So I'd say change the legislation, except I don't really think that's on the table. Look, I don't know. We've talked about this. Like, I think if you look at returns and generating returns over the next 5 to 10 years, there's a lot of conversations about the public markets being somewhat flat and whether it's a lost decade or this or that, but where multiples are as high as they currently are, how much further can it go? I don't know. And increasingly, along with the fact that more companies are staying private, that's going to push capital into the private markets without a doubt. So people are going to want to access private companies. Look, if we can't do something here in Australia, then it's probably going to push people to look offshore at a number of the names out of the US or Asia or Europe or whatever it may be that end up listing on the NASDAQ, which there's far more options than we have.
Or even trade in and out, I suppose, some names that are more liquid.
Yeah, definitely. Yeah, it becomes like a public market where you're in and out in a year, 2 years, whatever it may be. But look, my hope is that something can happen in Australia whereby there's reliable capital, is able to educate the masses, and even if it starts on a small scale, you get to a place whereby even if it's sort of companies that have a valuation of $1 billion only, that maybe there's 10 in there that we can start to do regular once-off or 6-monthly liquidity pieces where there's a more competitive process, so we don't just have 2 or 3 board members that are buyers, and we can get better execution for people.
And maybe adopt a sort of tender offering
100%
process that's been happening in the US, right? Which is a kind of new thing, almost as an alternative to needing to go private, needing to go public for these sort of late stage tech companies.
Yeah,
it's kind of interesting because, as you said, for private companies, it's important to keep control of the cap table, which is probably the primary driver for having those restrictions. But maybe they could come up with alternative share class that has concessions around being able to trade openly for employees or for different.
Well, exactly. Or the tender offer process. I mean, they can also convert shares to have certain rights and preferences.
You can change the bylaws. If for anyone participating in the tender, there's lots of things that can be done.
And in a way, you get certain, as you said, like trading in SPVs and so forth. So there's also an incentive for companies to. I mean, the company can't control, right? So folks can once people have a vehicle, the trading will happen, and it might be frustrating. So and there's like an adverse incentive then to support this kind of ecosystem. But on the other hand, it does happen.
I was going to say.
So perhaps exactly the incentive for founders of these later stage companies, for the CFOs to sort of think about is that actually, if it's going to happen anyway, it may as well happen with some level of control by the company.
Yeah. Do you want hundreds of millions of dollars of capital from parts of the world that you're probably not comfortable taking capital from doing forward contracts, or do you want to control who owns the SPV? And you demand some look through onto who the UBO is as LPs, and yes, that there's going to be transactions and trading, but potentially there's some sort of agreement whereby there's look through for the company on or quarterly updates, or if there's any sort of transaction above a $5 million threshold or something like that that can't transact within the SPV without the company sign off. There's lots of things that could be done if people wanted to work together.
Yeah, it was good conversation. Probably worth continuing to have the conversation.
How long is a piece of string?
Yeah. Well, I mean, over time and see how it develops. It'd be really interesting. I mean, I started my first company in New Zealand sort of 12 years ago, and the industry has changed a lot across also Southeast Asia, where I spent most of that time in Singapore. So it's interesting how to see how things develop in the venture industry.
Yeah.
Nice. Maybe one more topic to cover. How do you sort of see the differences? So you've invested, you've transacted across mostly Australia and the US, I suppose. Yeah. You've invested a lot in early stage across Southeast Asia and Australia. So it'd be interesting to get your take on what are the key differences for the listeners' consideration. Because we see Australians, angel investors participating in Southeast Asian deals, vice versa. You see, folks from everywhere like to get access to companies like SpaceX, Neuralink, the big names. So there's a lot of sort of overlap. But oftentimes, so for example, I don't understand the Australian startup market as well because I've spent most of the time in Singapore. So I think it'd be interesting. We'll have a diverse listenership here from across Southeast Asia, maybe some Europeans and Australians. So it'd be great to sort of get your take on where do you see the key differences in the market and how that affects the investment approach.
Yeah, I think we've kind of through our conversation today been talking about one of the key differences, which is tax. Australians pay a high rate of tax, much higher rate of tax than in Singapore, and so sometimes their investment behaviour is driven by that. So there are ESVCLP funds in Australia, which are early stage venture capital limited partner funds, which provide tax concessions on capital gains and so on, which means when you're comparing an Australian fund to a Singapore-based fund, the Australian fund has a leg up. It has an advantage from a tax perspective for Australian investors, right? Okay. So that has made Australian investors aware that they need to get a better return from a Southeast Asian fund than an Australian fund.
To make the net gain equal.
Yeah, so that's driven some behaviour around investing, but the Southeast Asian market and developing market there, middle class in different regions has driven a lot of growth. So you can offset that with a lot of growth, but it's just accessing the right investments and the right deals, and I think access is another.
Yeah, huge.
We haven't had access really in Australia to US secondaries easily, or at a check size, that's achievable for the average investor.
Yeah.
Maybe you could talk to him.
Yeah, I was going to say, my biggest feeling of what's different is there's sort of like a really high caliber group of people that really think independently and think outside the box. And then I find that there's sort of just a big group of people that just everyone has the same opinion. You kind of go to an event and it's the same thing on repeat, and it doesn't really matter where you go or who you talk to. And I think that's a bit dangerous, and I think we're missing a lot of really good opportunities as a result of that. Whereas in the US, people are very aggressive and they're hunting for what's different and what's new, and they're looking for edge at all times because it's so competitive. Whereas here, I think people are still a little bit happy with the status quo to an extent. And honestly, like what I've found in the secondaries market and having conversations, like for a while there, people sort of just looked at me and laughed me out the building. And then there are people doing, secondaries, and they're doing US names and, bite size of $250,000 or whatever it may be. I'm sure they negotiate down, but it's an interesting one, right? Because you talk to some family offices or quite prominent people, and they'll tell you, oh, that's the person to speak to. And I'll go and I'll have a look at the price they're offering or the terms they're offering, and it's miles off. It's miles off market. And I know from my experience, I won't name names or institutions or entities, but I know from my experience in working with clients in the US, other brokers in the US that had clients based here in Australia, how big the fee spreads were on some of this stuff. So there's
like a geo-tax.
There's we said offline, it's a geography tax. It's shrinking, but 21, 22, 23, the geography tax, if you're a buyer of late stage, growth stage, private markets equity out of the US, you paid 8 to 10% on the top just because you weren't based in the US and you didn't know much about it, and there wasn't much competition for you in your home market. So no one, your pricing wasn't shown up to be poor. And that's a huge issue, I think, here in this ecosystem at the moment. So,
buyers get more sophisticated over time, right?
It should.
In Singapore, I see that like folks are starting to ask the right questions, sort of understand and try to find better access. And I guess you try to find less layers in between at some point.
That's the other point. Yeah, how many layers are in between? And that's sort of a lost conversation here in Australia as well. People don't understand that most of this stuff transact at a double layer SPV, maybe a triple layer SPV. And they sort of just go, oh yeah, I'm investing with so-and-so. They know what they're doing. They said they got access, and they think, I can understand from what they're saying, they think they're going into a preferred round. It's like, no, that's not what's happening here.
Oftentimes, folks with small checks probably don't even know the share class.
No, exactly. And as a result, you've got fees. Like if you don't think that every layer you removed there's a layer of fees, you're dreaming. And so that would be a really nice thing for people to continue their education around here in Australia, that, the real differentiator is access and
so really the cross-border transaction process and structure to get cleaner, more transparent.
Cleaner and more transparent, 100%.
And to find the buy. I mean, you have obviously Macquarie, in SpaceX and so forth. So there are some of these more direct lines that investors can access, but I suppose they probably wouldn't sell anything below $500,000, maybe more now. So even if you're worth 10 million, you wouldn't invest 5% of your net worth into a single name. So these are, I agree, very interesting considerations.
Yeah, exactly right. And I think we were talking about this offline, but if you can kind of have this incredible quality access, but allow people to go in at $20, $30, $40, $50,000 bite sizes, maybe a bit bigger. That is a real game changer, because that doesn't really exist in the market, right? We work in a market where people don't do anything less than $1 million US. So aggregating that 5 or 10 grand at a time is very difficult, but and as a result,
managing the timeline.
Yeah, and all of these things. So as a result, then people doing that get much poorer access. So I think, there's a real opportunity there around quality access and more reasonable terms.
Interesting. I mean, one other point I've noticed, I just spent some time in Silicon Valley. You've lived there for some years.
Yeah.
I'm sure you visited. One thing I noticed, I speak less for Australia than for Southeast Asia, but I guess probably some similarities. Southeast Asia obviously is a much larger market, and it's a non-homogeneous market. There's different languages and so forth, and so they're all developing a little bit differently. Indonesia and Singapore are sort of probably still at the forefront, but then Vietnam is very interesting and growing fast. Philippines and Malaysia have their own nuances and interesting pockets of business and innovation. But one thing I noticed in the US, sort of the founder. And I suppose it's an older market. It has more memory, more learnings, much more money. It's a deeper, broader market. It's the largest Western or the largest sort of first world market really by far. And the founder quality that you meet is sort of the mindset is really quite different. I've noticed. So the American founders, at a certain level, you said, high caliber people. I mean, the default is sort of a lot of, or even young folks, right? They come out of university, they do a startup, they all live together in a house. They work all the time. They work through the weekend, they have dinner, they work at night. There's
obsessed.
Nothing else but work, right? So and whereas in New Zealand, at least, when I was there, so the work-life balance is a big thing, right? I mean, so you get laughed out the door coming with that kind of attitude to a US startup, right? So that's one big difference I'm seeing. And then also the expectation and the ambition, so Southeast Asian founders, I mean, there are, of course, many great founders and many great businesses have been built, but quite often, you have sort of companies that are at $1-2 million revenue, and they're around for 7 years and they keep going, sort of, we call that zombie companies, right? So they're sort of like why continue, right? I mean, it's a lifestyle business, and sure, there's nothing wrong with that. Some of these businesses made an, the healthy thing is probably if you really enjoy doing it, then turn it into an SME, try to get your investors out somehow and run it as a small profitable business. But in the US, I think the mindset is really more. I mean, some companies they get to $20-30 million revenue. If they're sophisticated founders and they don't like something about the margins or the market or how it's developing, they'll just drop it. They won't shut it down. Start another one. So there's a big sort of discrepancy that I see in terms of the thinking, the ambition, the aggressiveness with how to build. That is I mean, I think it's amazing in the US, right? And it's something to really learn from, and that's advice I give to founders I speak to, and I learn from myself. So I'd love to hear your point of view on how that sort of works here.
Yeah, I think that's very real. Look, what's wrong, what's right? I'm more of a proponent of, we all have choices for what we want from life, and then you pick your path. But I think if you're going down a path of taking venture capital, you're sort of picking that path of you need to be obsessed. So if you choose that path, then you need to behave or match your competition, I suppose. Which, they're quite obsessed, and it's interesting. Like I met with a young guy here not that long ago, and he was sort of talking to me, and he was echoing your sentiments a bit, and he was sort of saying, I just want to surround myself with as many people as possible that understand what the US is like and what the Valley is like. Because he's like, it's night and day. And that's where he wants to play. So so you're right. But I think it's just a choice people make. Yeah,
I mean, it's also, I mean, the other side of it, not expressing a strong opinion against what's good or what's, I mean, I think it's clear that the US way, is able to create more larger companies, but also, of course, there's the market.
Yeah.
But on the other hand, there's also sort of the not so healthy side of it, of course, of the mental health impact and so forth, and the education around it, and how to take good care of yourself. And I mean, you really can't expect people So if the default position is not like your contract says 40 hours, but I want you to work 80.
Yeah.
Like so there's this kind of stuff like it's a mindset thing that I think you're also very right. You have to sort of respect and deal with what's available, right? In terms of the
There's a couple of elements as well. The degree of difficulty of scaling a business, right? Like in the US, the market is just so much bigger. For Australian founders trying to scale a business, they have to scale into the US or into other geographies, and the degree of difficulty of doing that is pretty high. To break into the US market from Australia, you really need to
go all in.
Yeah, go all in, and I think that's somewhere where potentially government could help. Is actually help, and they do have some programs, I think, and pathways to help founders scale into the US. But I know with a couple of scale-ups I've been involved in, their first couple of deals in the US are as big as their whole business in Australia. Right? And New Zealand founders, they're fantastic, right? Because they realise day one that they have to be global, right? They're day one, you have to be global because you're not going to rely on the size of the local market or the domestic market to survive. So they kind of start to focus outwards immediately and quite often successfully.
Xero is a fantastic story, for example. These kind of
absolutely.
things.
And there's quite a few of them out of New Zealand that have done really, really well. And I think for that reason, whereas in Australia, you can kind of build your business to a certain level, without having to go offshore. But eventually you either become one of those zombie companies or you find a way to scale offshore. And
or you have extremely deep penetration, like a sort of Trade Me or these kind of companies, right? It really dominates the market. It's the only way to.
I think that's a great point. I was thinking about that because I don't want to speak ill of founders in this part of the world, because myself, I'm actually incredibly bullish on venture in Australia and New Zealand, and I think sort of the terms that you can invest in for the progress that a companies are made and how capital efficient they are and how well structured they are. It's, as an investor, you get a lot more bang for your buck here than you do in the US. So I kind of think, and then to your point on New Zealand, love New Zealand. I think what Australia is to New Zealand, I guess in terms of the things I just mentioned, New Zealand is to Australia. I think it's an incredible opportunity with incredible founders and incredible terms for an investor at times too.
Yeah.
Actually, I find that terms on Australian companies tend to be much more reasonable on average than in Southeast Asia as well. Interestingly,
definitely.
Probably still further behind in a way, right? Like that trickle down from the US probably goes via Asia before it comes here.
Maybe, norms. Or maybe the investors are. Because at the sort of seed round is often, I guess, also driven by the angel community, and maybe another way. I really don't know for sure, but I wonder if it's also that the investors are kind of pricing it a little bit more reasonably within there in their minds, maybe. And then in Southeast Asia, there's sort of there's
a lot of competition in Southeast Asia, right? You've got a lot more investors, right, fighting over probably a small, not a smaller pool of companies, but there's a pool of companies raising. But there's a lot of competition amongst investors in Southeast Asia, and you've seen like investors rush into geographies in Southeast Asia because of the growth potential, Indonesia and India and so on, and sometimes those markets have pleased, sometimes they absolutely haven't.
They've not,
and the valuations have been way too high on investments in some of those areas, as it turns out. But I think in Australia, there's a smaller pool of investors, so sometimes the value, and they're more conservative than some of the capital that's available in Southeast Asia.
Yeah, definitely. I was going to say it's I think it's a byproduct of competition 1,000 times over. Look, you can make arguments about who's in what tier, but there's probably some tiers to Australian venture, and if you want to index that top tier, you don't need to invest in any more funds than count them on one hand. To index the entire market, and that probably speaks to a bit of a lack of competition and potentially more favourable terms, but also a huge opportunity.
Makes sense. Yeah. Nice. Well, maybe we finish up with industry wins and fails. Can be anywhere. Can be a US thing, or can be politically related. What are you?
Trouble.
What are your recent wins and fails in the tech and venture ecosystem? Could this be a company you love or somebody doing something really well?
I was gonna say for me, I'm honestly, I'm in love with New Zealand as a region. Tracksuit and Halter, I love those two companies. They're like if they raise again and I can somehow get into a vehicle that's doing either of those, that I think they're unbelievable. And I'm very bullish on everything I've sort of, all the exposure I've got to the New Zealand market.
Nice.
We talked about Icehouse Ventures, their structures.
Shout out to Robbie.
Yeah,
Robbie.
Those guys are unreal. That for me, I think that model, the way they do things, the quality of the companies, that for me, I love.
That's a win.
Yeah, that's a huge win. I just think it's really cool.
I love some of the companies over there as well. Sharesies has done super well.
Fantastic. You guys are in there.
And Dexibit over there has had a hard time through COVID, but they're now coming out of that and growing. And there's some really good companies out of New Zealand. I think Nexel in Australia is going quite well. It's nice to see that company start to scale and build their business into the US successfully. So it's great to see those things happening. And the other thing I'm enjoying a bit is the diversity that's starting to come into the market now. There was like this huge focus on just enterprise software and SaaS for a long time, and now we're starting to see more open mindedness towards med tech and biotech, health tech, deep tech. There's all sorts of the variety of what's coming through is interesting.
Yeah. To say one more shout out. Actually, I walked away really excited from meeting these guys. There's two young guys in university raising a fund called Next Era. I think they've raised $1 million or maybe $1.5 million. They're targeting 2.5, I think, with the thesis being that the AI evolution or revolution probably means that you don't need to hire as many employees, and you can sort of use AI and AI tools to probably offset your first 5, 6, 7, 8 staff members. And as a result, if you can kind of take a very little bit of capital early, that can get you much further along to then raise on more favourable terms and it potentially get you outside Australia, get you to a US raise and a US valuation, which is probably better dilution-wise for a founder. And anyway, their thesis is that it's basically like a dorm room fund. They're going to find the most talented young people at university in Australia, whether that's, deep tech sort of PhD students, science backgrounds, maybe tap into sort of like some of our farming, or whether it's like physiotherapy, some of these kind of niche industries that we have really great global competitive standards and global positioning that we don't really know about, and could be SaaS, could be whatever, but those guys going super early, small bite size, I think they're going to have a lot of success, so good for them.
And
got me pumped up.
That's kind of a trend, isn't it, a bit with some of the really early stage AI businesses that are emerging. They're doing very small rounds, stealth rounds, if you like, raising 500K without much noise at all, and without having to talk about what they're doing. And I think as they start to grow now and emerge, there's going to be some really exciting new companies coming on.
100%.
Nice. No fails? I have to cover the fails.
Fails. It's been a frustrating 12, 18 months in terms of pre-IPO is tough when there's not when the IPO window is mostly closed.
When there's no IPOs.
Yeah, exactly. And I think, the change of legislation in the US brought a lot of excitement, and a lot of people had a lot of money ready to deploy, and probably a little bit nervous at the moment, which is potentially a little frustrating.
Yes.
So how the IPO market in Australia, obviously, like almost completely asleep. I think there was one last year, wasn't it?
There was one.
Yeah, I think that was it. Do you see that opening up? Do you see it changing? Do you see that being a viable pathway again at some stage?
I mean, honestly, I'm probably not the right person to talk to. I know far more about the US climate than I do the Australian climate, but I think it's inevitable and it has to happen. I think it has to happen potentially like some dual listings and split listings, just because the multiple those same businesses can get here will probably be higher, just because there is such a lack of top tier technology businesses and these sorts of things. So yeah, I think it will happen, should happen. Potentially some of those companies we talked about that don't quite get near the scale of what's needed for the NASDAQ. I think it's probably a lot healthier if they list here, if the market can support it, hopefully. But yeah, I think those sorts of things will happen without a doubt.
It's kind of when you think about how long someone like Canva's held themselves back from IPOing. It's like in Australia, like I wonder where that scale is that you're actually willing to go to an IPO, because it's in Australia, it's hard to get to $100 million turnover. I wonder where that's going to be.
Yeah.
Well, my wins and fails in AI, I would say is I was just in San Jose visiting Figure AI headquarter and looking at the robots and the way they do sort of sensitivity training and with picking up things and and sorting packages and kind of thing. And I think it's just really I think we live in an incredible time. It's a big win for me is where now you have this convergence of sort of robotics, deep tech, AI and hardware changes, and the combination of all these factors I think is really amazing. And I think a lot of folks may not quite realize this, but it's just in a few years we'll have robot maids in houses that will do your cooking, your cleaning, your tidying up, and making you a cocktail kind of thing. So I think that's really, really fantastic and something to look forward to. When I was a kid, you think of flying cars or that kind of thing, right? And I think we're now kind of really, really entering that era where a lot of these amazing things are really going to be possible because of the overlap of these different technologies. And so that's very exciting. Big fail for me is call centers. You would have thought they would have figured out by now how to make that better with AI. I mean, I fly a lot and I'm on call centers, and I mean it is such a frustrating experience. Why have they still not figured this out?
I don't know.
Shouldn't AI be able to figure this out?
I don't know.
Absolutely.
I don't know. I don't know. I don't know, mate. I don't know. I'll leave that one with you.
All right. Well, thank you for joining us today. Our third episode of the Accidental VC. Hopefully back here in Sydney soon. Thank you very much for joining me, you and Jack.
Of course.
It's been a pleasure.
Thank you.
Cheers.
Awesome. Cheers.